The difference between 5% down and 20% down from a monthly payment standpoint is $244. Hi, I'm Mark Anderson. I'm a mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states. I would love the opportunity to earn your business. So if you have a question about a purchase mortgage or a refinance scenario, please call or text me at the number below anytime. For today's quick tip video, we're going to talk about down payment and how that down payment impacts your monthly payment. Now, what you see on the screen here, fair warning, there is math involved in this video. What you see on the screen is a section from a spreadsheet tool. This is a spreadsheet tool that I put together for my purchase clients at the pre-approval stage. It is a very, very handy tool that I basically tailor for my client's scenario. I input a specific rate and some other variables involved to make sure that they're able to run their own calculations for different prices, different property tax amounts, etc. And what we're using it for in this video is to really walk through what different levels of down payment do to the monthly payment. The reason that this came up is that when I was on the phone with this potential client, the subject of down payment came up. And I said, well, how much can you comfortably put down? Paused and said, well, you know, I know that you're supposed to put 20% down. And I think maybe I can stretch and get there to the 20% down payment. And I kind of pressed him a little bit and I said, you know, is this going to put you in a position where on the day of closing, you don't have much cash to lean on after the date of closing? And he said, well, yeah, I mean, in a perfect world, I guess I would rather maybe not put that much down, but I know that you're supposed to. I want to dispel that notion completely. There is no correct answer for how much you should put down for your mortgage. That is a decision that involves some math. It involves trade-offs. It involves an understanding of the value of money, not just as it relates to a monthly payment, but what that money can do for you after you close. I want to make sure to set my clients up for success, not just to get to the closing table, but to be properly prepared for homeownership, you know, the day after. I find in general, and actually I did a survey of some past clients several years ago where I kind of polled, you know, what's something that you would have changed? If you had to do the mortgage process all over again, what's something that you would have changed? And a common theme came up that people said, you know, I really wish I would have left myself some more cash. So this video is meant to illustrate the difference in monthly payment at different down payment levels. And I think what you're going to find is that the impact on your monthly payment is not as much as you might think. So where we're going to start on this calculator tool is on a purchase price of $300,000. We're going to keep that the same across the four scenarios we're going to look at. We're looking at a 20% down payment. Now, one thing I have to get out of the way from a legal standpoint, I put here, this is a sample interest rate. And the reason I state that it is not possible for me to quote specific rates on this channel for a whole slew of reasons. So this rate is being included to illustrate the math for this down payment calculation pathway we're running down here. It is not meant to be a quote because I can't do that, and I'm not doing that now. So what we've got is a $300,000 purchase price, 20% down payment that gives us a loan amount of $240,000. Now at this sample interest rate of 2.375, we get a principal and interest of $933,000. We add in the taxes, we add in the homeowner's insurance, we end up at this total bottom line of $1,433. Now, the reason that people say that you should, or in some cases say you even have to, put 20% down is that if you don't put at least 20% down, you have to pay private mortgage insurance. Now, I don't think there is a single financial instrument or product more hated than PMI. But I think as you'll see in the math that we go through here, PMI is not the worst thing in the world. And if paying PMI for a period of time puts you in a position where on the day after closing, you've got some money left over to do the things that you're going to need / want, because need and want starts to kind of blur after you buy a house, to do, it may be more useful for you to have that money available rather than avoiding that monthly PMI payment. So this is the math on 20% down. Total payment, $1,433. 33. We are going to switch to 5% down. All right, 5% down. All the other variables remain the same. Interest rate remains the same. One thing a lot of people don't know is they tend to assume that the more money you put down, the lower your rate's going to be. That's true in some cases. Every loan has to be priced out. There's a bunch of different factors that are involved in that. But generally speaking, your rate's going to be in the ballpark or the same as it is in this particular case. So at this sample interest rate of 2.375, the principal and interest payment does come up because it's a higher loan amount. You're borrowing more. Taxes, insurance don't change depending on your down payment. And then we have the dreaded private mortgage insurance at $69 a month. Now, full disclosure, I did run these numbers assuming a very high credit score. And your PMI rates, the actual factor that's used to determine the monthly cost of the PMI, that is credit score dependent. You're going to have much lower PMI costs if you have a high credit score, and the PMI costs can actually ramp up to become quite expensive. Like if you have a credit score under 700, the PMI gets really pricey. So we've got in this scenario $69 a month for a total payment of $1,677. The difference between 5% down and 20% down from a monthly payment standpoint is $244 in the monthly payment. The difference in cash out of pocket is $15,000 versus $60,000 in this case. So if freeing up that $45,000 gives you value equal to paying $69 a month for the privilege, I would argue that it's worth it. Many people are actually very surprised to see that the difference in payment is not quite as significant as they would tend to assume based on that higher or lower down payment. Now, there's another thing I'm going to talk about here while we're here. There is an alternative to monthly private mortgage insurance. If you are morally or ethically opposed to paying PMI on a monthly basis, you can pay a single lump sum at the closing table, and that knocks out any of your PMI obligation for the entire life of the loan. Now, I'd want to run the math with you to see if it makes sense for your scenario, but there is an option that would allow you to avoid that monthly PMI. So next up, let's go to 10% down. So on 10% down, of course, all the main variables stay the same: purchase price, rate, etc. Principal and interest payment $1,049. The PMI in this case, because you're putting more than 5%, you're in the next bucket for the calculation of the private mortgage insurance. So that goes down to $47 a month for a total payment of $1,597. Just as the monthly PMI payment went down, the single premium PMI option went down in this case to $2,322. And then the last scenario we'll look at, this is, I think this is the most awkward down payment. 15% down it's tough for me to justify for most scenarios. Because for most people, if you can afford to do the 15% down comfortably, maybe coming up with that extra 5% is not much of a stretch. Conversely, if 15% down is a stretch, as you'll see, the actual net difference on the 15% down versus the 10% down is not that much at all. You've got a PMI payment that's a little bit cheaper by $10 a month, $32. And then, of course, your single premium is about half of what the cost was at 10% down. But it's not that different. And I really want to emphasize, to close out this video, that for any mortgage scenario, when I'm working with my clients, I use this phrase all the time: let's let the math do the talking. There's not a right answer that comes from the mortgage authorities that says what you have to do. I view my job as being an educator. I want to provide my clients all of the options that are available. I have tons and tons of clients that could very easily do 20% down to avoid the PMI. They've got loads of dough set aside, and what they choose to do in many cases is to go for the minimum down. Now, I'm not saying that that's the best strategy for everybody, because again, I'm kind of allergic to the idea that there's a one-size-fits-all mortgage solution, because it's just kind of antithetical to what I believe and how I practice my business. But I think it's worth investigating these options, weighing the pros and cons. There are trade-offs no matter what you do, whether it's extra money out of pocket now to avoid that annoying monthly PMI, or if that monthly PMI is worth it to free up that cash to do maybe some other things that you would want to do with that money. So thank you so much for watching this video. Please do like the video, subscribe to my channel, and I look forward to talking to you again very soon. Thanks.